Here we go.
Hey!
Here we go.
Hey!
Okay, well, here we are. Welcome to this week's Australian Investors Podcast. As always, I'm joined by Seven Investing's investment advisor, Anirban. How you going, mate? Always a pleasure, mate.
I'm great, but today's a special day, right?
Yes, today's a very special day. We have a third co-host with us today who just had a dramatic entrance for those of you that are watching live or watch the video. Claude Walker from A Rich Life, mate. How you going?
I'm very well. So happy to be here. See you guys' faces again. Obviously missed catching up with you for the last year or so.
Yeah. It's been a bit of a tough year for everyone. Hey, how's your day been so far, mate? What have you been up to?
I had a morning with a fund manager I admire, so I got to learn a lot then. And this week generally it's just been outrageously busy for me. So I guess I'll put that up front. I'm sorry for the Rich Life subscribers. I haven't published as much as I usually do lately. I've got some stuff I can't talk about at the moment. It's been taking my time, but there's going to be at least 3 articles on the website tomorrow for the next issue. So and they're going to be good ones. So sorry
Check
about
it out.
the delay.
That's at richlife.com.au, and that would be Saturday, the 6th of November. So we're recording this on the Friday, the 5th. If you ever want to catch us live, you can head to the Rask Australia YouTube channel and hit subscribe. You get a notification when we go live. Normally, the way we start the show, mate, as you would know, is we just ask each other what we've been working on lately because it provides some insight of what's been going on behind the scenes. Today, we're going to talk about some topical things as well. We've got results that have just come out from Pinterest this morning. As always, we have to mention Pro Medicus whenever Claude is in the room. And Anirban's going to take us through Peloton and a look at Cloudflare. So we've got a lot to talk about too. We've got some ASX news around IntelliHR and Tyro Payments this week. So a lot to get through. But first of all, maybe as I usually do, Anirban, what have you been working on lately? I feel like there was a webinar in the offing.
Yeah, so I finished, the recommendations are out 1st of November. And yeah, there's a webinar actually that's happening on cybersecurity and zero trust. So there's a report that I've written on zero trust and what that framework means and why that framework is important and who are the players in that sort of zero trust cybersecurity setting who could potentially win. So we're going to do a webinar, short presentation, maybe 20 odd minutes of presentation followed by some question and answers and talk about the stocks and what's going on there. It's been a hot area. It's been a good area to be in as an investor over the past couple of years. But, what has happened in the past is not really that relevant, right? What's going to happen in the future is relevant. So that's sort of the thing we're going to be discussing.
And is this a free webinar that anyone can go to?
Yeah, so it's free. So the report is free as well. I mean, okay, I'll caveat that. You basically give your email address and you get the report for free. And it took me a long time to actually write the report. So I think it's worth something. And I've got some illustrations there, which if you enjoy my drawings on my iPad using my Apple Pencil, free Apple advertisement there, then please come and enjoy that. Yeah, and the webinar is free. So if you've got your email address, we'll just email you details of when. Actually, the information, we're going to do it next Saturday morning, Australia time, which will be Friday, 3 p.m. Eastern time in the US. So early morning here in Australia.
Mate, if I'm already a subscriber to Seven Investing, is that going to be on the website as well?
Excellent question. I don't know actually of the details. So this is primarily directed towards people who are not yet members because essentially the stocks that you're going to talk about, many of them are already recommendations. So you already have access to all the recommendations and updates. But if you want to join, you're welcome to join. we'll provide you. If you want to wake up in the morning and join, we'll take you.
Why not? There'll be a recording.
Yeah,
there'll be a recording. Actually, that's a good point. Maybe we should make the recording available to everyone on as a subscriber. That's actually a good point. So I'll raise that up.
Nice one.
I put a link in the I'll put a link in the show notes, and there's it's also on Twitter as well. So be sure to follow us and say good day, and you'll see it there. And just on that, if you are watching live and you want to ask a question, feel free. Now's your chance. We'll try and get to that throughout the recording for the next 60 minutes. We love questions. Engagement is good. So please feed us. We are hungry. Claude, how about yourself, mate? I know you've had a pretty hectic couple of weeks and whatever. It's been a lot of like 4Cs and AGMs coming up out recently. Maybe before you answer that though, just tell us a little bit about A Rich Life for those of our listeners that are new to you and new to the podcast series.
Yeah, right. So A Rich Life's a little bit different from Rask Finance and Seven Investing. We don't do recommendations or anything like that. But what we do is coverage of a lot of small cap stocks that you really won't find coverage of many other places, and we try to make sure that we're covering that universe before other people. So I have a great network of people like you guys who are constantly feeding me excellent ideas. I'm really just looking to try and write those interesting stories and do the work in the background to make sure that, generally speaking, I'm not writing about companies that are actually just hype and have no real potential. Obviously, all small cap stocks are high risk, high reward, so I get them wrong sometimes, and we're going to talk about one of those today. But I do pride myself on trying to write about real businesses that really do have some prospects. And of course, when they go well, then just knowing about them early can be a great help to people and can be in front of the curve sometimes when some of the other players come in behind us. So that's what we aim to do. And the last week has been, at first, I need to catch up on, there's a few more quarterly reports I've got to cover for the website this weekend. That'll be one article. And then we've got another article, which I'm fairly excited about, which is about two turnaround, and I won't give them away yet because I haven't published the article, but two turnaround software companies that are both looking pretty healthy right now. And I think that as their reputations are now likely to be improving over the next year or so, we may get a situation where we would get both company growth, so the underlying business is growing, but also that sort of sociological re-rate as people say, more and more people sort of started realizing, this is actually a better company than it was now, so maybe it deserves a higher multiple. So trying to play that, the double win if it works out.
Yeah. Well, do you find that you use your network a fair bit? Do you find most of your good ideas come from people that you know and investors that you follow, or is it through primary research? Actually, do you use things like screeners and that type of stuff at all?
Yeah, so I do use screening tools a lot, but the trick for me is to set those screens pretty wide and then go through a lot of companies manually. And then the network of people that I know, that's really just another level of filtering. I'll go and filter and I'll look at in a week when I'm doing the broad stroke, which I did actually not that long ago, I call it repopulating the watch list, go through 100 companies or something. And then after that, I'll find some that I find it interesting. I'll generally write about some, and a lot of people in my network do read my writing, or if they don't, I send them the article and say, what do you think about this? And then that helps me start to know which of those companies I should zoom in on more, because it's just hugely advantageous to have all of these very clever fund managers that have information to share. And that doesn't mean I'm like, they like it, that means I like it. It just tells me which ones I should be looking into even more closely, basically.
And I think that's particularly in Australian small caps, right? If you do the filter and you don't set it broad, you end up missing a lot, because you just get what it's like. If you exclude those companies that are yet to be profitable, the list shrinks. Outside of mining, outside of resources, you're left with maybe 200 companies, and you're like, well, geez, okay, maybe I need to broaden this a bit. But then it just puts the onus back on you a bit. So that's really interesting. And just for those that are new to Claude as well, he, like both Anirban and myself, are on Twitter, so you can find the links in the show notes. Claude D. Walker on Twitter. So say
I should
good day to
probably
him on there.
mention, to give fair credence to my colleagues as well, I'm only one of the writers on A Rich Life, and the other segments are about news, about opinion, and about arts and culture. So it's not just a finance kind of thing. It's a bigger. We're trying to be sort of an AFR kind of thing, but a little bit of a new millennial spin on that.
Yeah, cool. Once again, links are in the show notes, so check it out. Check out all the writing. I'm looking forward to reading that one. And repopulating the watch list is always an interesting thing to see what surfaces after all the IPOs we've had recently. Just an update from my end. Those regular listeners of the Australian Investors Podcast will know that we had Julia Forrest on the podcast recently. She is a fund manager from Pendle Group. She's been on the I guess the scene for I think about 16 or 17 years from the top of my head, maybe even longer than that now. So she's one of those long-serving fund managers, which are very rare because oftentimes they move on to other endeavors or whatever. But she stayed in her kind of field, which is property and REITs and those types of things. So we had a really interesting conversation around inflation. You can get that. That came out on Wednesday, Australian time. The other thing that this is totally different altogether. The other thing that I've been waiting on is my Starlink. So maybe next week or the week after, once this backlog of postage works itself out all around Australia, we should be able to get it and install it. And then we might do 2 Starlink connections and we'll see how we go. That could be a bit of a challenge, particularly if there's 3 of us on a call. So watch this space. Okay, so today we're going to talk about a few things. Claude, I figured maybe we can start with you, mate, because this one came through, I think, and Anirban and myself saw this on Twitter. Bet's got a comment to say, what's the latest with Damtra? I know you were on AusBiz recently and you spoke about that. So did you want to just talk just quickly about that? Anything that you can add there, maybe tell us what the business does and give us a rundown?
Yeah, so I would be happy to, but I also invite Anirban to weigh in on this one as well, because he knows a little about the company as well, I think. So what Damtra does is basically workplace health and safety tracking and monitoring. So that starts with, a terminal at a work site that tracks who goes in, but it can extend all the way to you have something on your phone, an app downloaded on your phone that can then track if you're driving safely. And also the machinery can get tracked. So just to make sure that each bit of machinery can have a file basically that says, when it needs to be maintained, who is in charge of all of that, whether it's got any signs that it needs to be fixed, and, also preventing things going missing so easily, cataloging and that kind of thing. So that's their kind of business. It has a fairly broad range of clientele, but construction industry and mining industry is a huge part of it. And so there is a degree to which large contracts or large customers can have a big impact on its bottom line. And, the story with this one was that I sort of first started writing about it when we had the sort of blowout in after the blowout in March 2020, when a lot of money losing names tanked. And it looked to me at the time, I had a thesis, which I think right now is in tatters, but it looked to me as if this would be something that, would become more front of mind when, who is on, on the site. Are they we didn't know at that time how everything would play out with COVID, but it was certainly imaginable that things like having COVID tests and vaccinations and all that kind of thing might be relevant and become more relevant to workplaces. So I thought, this is probably actually a tailwind for these guys. They've come down, they're a bit smashed out, so we'll buy it. And I bought it and thought it was good, and it sort of went all the way up, and it's been driving its growth through a combination of a little bit of organic growth plus mergers and acquisitions. And it had a bit of a decent track record with mergers and acquisitions as well, stripping costs out pretty effectively. So that was the thesis, and it went on to acquire another listed company, Vault, which I think was slightly lower quality business, but it did have technology that sort of fit into the Damtra technology stack fairly well. So that kind of made sense as well. And that was when I was most optimistic about the stock, and lo and behold, so was the market. And at that point I was sitting on a 100% gain. And unfortunately, the forecasts that the company had given at the time of the Vault acquisition, in terms of what the pro forma revenue would, all those sort of things would be, it came in short of that. And the shortness was probably more in the core Damtra business, or the one that had existed prior to Vault, rather than the actual acquisition. So it wasn't necessarily one bad acquisition. It was actually the business was a bit soft. Now, in hindsight, that was the time for me to at least sell half of my shares and say, my original thesis did not consider that the core business would be soft. Actually, what I thought in the original thesis was the core business would be strong, and any good acquisitions on top of that would be cream. But it actually didn't really work like that. And it seemed like the acquisition was okay, but the business was a bit soft. that was the time that I should have been selling in hindsight. And there's, I think that, we can have probably a bit of a group discussion, and you guys can tell me why you think I blew it on that occasion, but I didn't do anything. In fact, I bought more. And that was the making of Bag Holder, because they then gave guidance again and they missed it again. And in fact, because they lost a big client. And so this is a double disaster now, because the numbers have come in lower, but it's the old story about fool me once, shame on you, fool me twice, shame on me. And you really, if you're a business and you miss guidance twice, you really, the people that actually have been believing in you past that first time, you really do cause them a lot of humiliation and pain, and that what they then regret is that they trusted you again. It's a really dangerous place to be when you are a publicly traded stock, and trust is so important. So, in my opinion, it's just not right. Like, if you can't hit that guidance, then you just don't give guidance. You say, oh, we don't know how much we're going to make. We think we're going to grow. And then the market doesn't feel lied to. If growth comes in a little under what you're expecting, which is kind of the story here, oh, well, they actually did go down quarter on quarter, I think. So there wasn't even growth. But, if the year's growth is going to be lower than you'd expected, then you at least have maintained the credibility. And so people will be more likely to trust you and stick with the story. So with that second guidance miss, I've gone and, as I wrote about, at the time behind the paywall, look, we've got a double trouble now because we've got a credibility gap opening up. And so I just forced myself then to sell some, and that was at a bit above 80 cents. And, I think the share price has continued to drop down since then. And I think, a lot of the questions we had on Twitter and that kind of thing, it's that people are asking, oh, yeah, we know that this has been a blow up from $2. And we, of course, know in hindsight, we should have been selling, not buying on the way down. But, what about now? Now it's at 65 cents or 70 cents or wherever it sits. It's trading at less than 5 times annualized recurring revenue, despite that, having been reduced by this customer loss. And so if you believe in the long-term growth, you could argue that, actually now it's kind of cheap, and it may well be that now is the bottom. Like, they've lost a big client. It's something that doesn't happen very often. It's happened this time, and they've had the credibility gap. You could argue that now being a low point in both the financial performance and the sociological opinion of the company is like the worst possible time to sell. That is a possibility. And as a result of that, I've kept some of my shares. I actually sold a little more this week. So I'm really not, I don't have confidence in that story really, but it can absolutely happen. And we've all had stocks where we've just been absolutely wrong-footed, and you buy too high and then you sell the low. And it's obviously the absolute opposite of the aim as you want to do when you're investing. But at the same time, and this is where I'd love to get your opinions on the same matter, like to abstract the question a little bit, what is the best thing to do when you've had something, you've just been wrong on the thesis, you've misread the situation, things are going are not as well as you thought, but now the share price is down. Do you keep saying, oh, well, yeah, but the share price drop has now compensated for the bad news, so I'm going to keep on holding and I'm keep on holding on? And I guess that maximizes the chance that you'll have a positive return on that position eventually. Or do you say, look, this is one that I have not been calling well. Yeah, sure, it may go up well, or it may not. But the point is that I don't seem to have any edge in this stock. I'm going to take my capital out of that and try and put it in something where I believe that I actually am calling it better than the market and more likely to make money. You guys are muted.
Oh. You go first, mate.
No, you were saying something, so you should utter those words now that it's been unmuted.
Okay, maybe I'll keep it short. Maybe sell it.
Yeah.
No. But I probably, to be honest, I probably would. I don't know much about the company, in truth, so I can't really speak from that. Just in a general sense, I'd probably sell because, we talk about opportunity cost, sunk cost fallacy, all that sort of stuff, and I think. in these situations, I tend to just cut and run. And I think you've kind of taught me this over the years, is that typically those have been good decisions when you've done that. So maybe I'm just taking a leaf out of your book, but I tend to, my selling's been pretty bad, but regret minimization too. I think if you find a higher quality position, that would probably be my 2 cents. Mate, Anirban, I think you know a bit more about it. So
yeah, I was going to actually, you stole my word. So one of the things that Claude Walker is actually really, really good at, and this is his specialty, right? So when you're looking at what he calls small caps, I call them micro caps, right? In my lens, they're all micro caps. So one of the things in micro caps or small caps, really, that in the ASX small caps, is you really need to be a bit nimble, because this business has an ARR of less than $30 million. $30 million is, it's basically nothing, right? These sort of businesses can blow up. They can go to the moon, but they can also blow up. And therefore being a bit more nimble, I think is important. If you have a adjacent quarter decline in ARR, especially, my guess is, I had to look at the report, but it's not clearly broken out, that it looks like there's acquisition also included in that ARR growth, right? So it's not really all organic. Descoping is a word that is a very fancy word. Descoping, I find that word, like, you're descoping by a big customer basically can mean a lot of things, right? But a big customer descoping is usually negative in my view. So, then the question I would ask is 4x or 5x ARR a good multiple? Maybe it is, but you need maybe 20%, 30% ARR growth, and maybe you're hoping for the multiple to go from 5 to 8, right? Maybe it happens, maybe it doesn't happen, but maybe there are better ideas out there. So that's, yeah. The one thing that I noted, which was on the last page of this, which is a pretty fancy way of doing these things, is the Vault CEO is out. So that doesn't tell me good things about this acquisition and integration and whatnot, right? So, I followed the stock quite closely a while back, and I thought it was a good business, and I think it had some benefits during COVID time, but I'm not sure what happened here. The churn rate seemed to be pretty high, like at 5-6%. So normally, normally the numbers are not encouraging, but yeah, I mean, maybe being nimble is probably worthwhile. But here's the thing, right? It may be that from this point on, the stock goes on to do really well, right? It could double and triple, but maybe it doesn't. You got to make the decision based on what we have right now. And then the other thing is that, I guess, if you sell it and if you can find something else that does equally good, then that's okay. Although it's hard to make two decisions, making back-to-back decisions is harder. So I tend to not, I tend to be a slow seller. I actually don't sell, but generally don't sell. And what that means is my position just becomes smaller and smaller and smaller, and eventually it does not matter. Like, should I sell? I'll pay more in brokerage for selling than anything else. So, but yeah, so if I own the stock, I might actually not do anything. I would definitely not be buying at this point, like, at least in my opinion, because it's basically a punt at this time, right? It's really hard to tell whether the business momentum is there or not. And then it's very acquisitive, right? There's Vault, now there's Tix, and now Tix is apparently working with Amazon, and maybe great things will happen. But if great things will happen, there'll be plenty of time sometimes to buy. So that's what I think. But
yeah, it's a tough one. I would say, it's when you do your valuations, I typically rely on my valuations when something goes against me. So I have my thesis, do my valuation, and then I rely on that. But then if management credibility is brought in to that conversation, that makes it very hard for me to rely on their execution, which then that's pretty much my valuation is based on their execution. So, I find it pretty hard to price poor credibility. So I tend to not stick around. But speaking of selling, mate, this is directed at you, Anirban. I heard on the grapevine, which we know now to be Twitter, that you sold some of your Tesla stock. So sold some of your famed Tesla holding. Tell us a little bit about this. So did you sell it all? Did you sell part? Talk us through the decision.
Yeah, so Tesla recently hit, like, say, $1 trillion of valuation, or right now it's like 1.2 trillion or something. So my decision was, as I said in my post, was not really based on valuation. I think it's somewhat around fair value right now for the auto business, which sounds like a strange thing to say, but it is. Like, that's what I think it is. And so my Tesla position was nearly 40% of all the portfolios that I managed put together. That is an incredibly high allocation to a single company. And I first bought the shares in 2013, and I went really big in 2018 and 2019. Like when 2018 and 2019, when Tesla was supposedly dying, maybe came close to that, I really went big because I had pretty high conviction. Now, you can call it a punt at that time because, I mean, I could have been wrong. But that was those particular investments. So, I mean, just ignore the 2013 one because, that is up many fold. But actually in 2018, 2019, you could have invested and you'd be up 25x to 30x. So I went really big. So I had a really big position in Tesla. And how do I say this? So I felt that a couple of things. One, 40% in any position, even if it is probably what I call the single most important company on the planet, because they're not only solving important problems, led by probably a visionary that the world has not seen for a long time. All those things put aside, the sheer sum of money is important to me. So I thought, well, I can't, at that point, the volatility became too much for me or a big consideration for me. So I thought so I reduced my position by about 40%. It's still a very, very big position for a single company. Normally I would not say that people should have that kind of position, but I reduced my position by 40% just to, I'll pay taxes on it and that's fine. But I felt that I needed to take some money off the table just to just be happy.
Those taxes can be brutal on a big winner.
Those taxes can be a brutal and a big winner, but I mean, it's better to pay taxes than to not pay taxes, right? I mean, I basically mean something went well, which is a good problem to have. And so it was a portfolio management type of decision. I'm not a big portfolio management type of guy. Like I don't actively manage my portfolio. But this was like staring at my face saying it's too big. It's still a battleground stock, right? I mean, the thing is that it's still a volatile stock. It can go up 40%, it can go down 40%. So,
well, here's an interesting theory that I heard today, which was that for a lot of the retail trade, are you guys hearing me properly, by the way? Can you still hear me?
Yeah,
we got you.
Change the microphone then. But the theory is that for a lot of the, I guess, like trade speculators that are trading on that are own and trading, high multiple growth stocks in the US, for a lot of them, they own Tesla. So when Tesla goes up, they have more collateral on which to speculate in like all the other like high growth, sort of meme stock kind of names as well. So that's why when Tesla can lead the pack there. Now, of course, that sort of is in some ways a scary thought if you do own these kind of businesses, because when that means that, like, even though you think, oh no, I don't own, so this is in my head, I'm like, well, I don't own Tesla, right? But I do own like a lot of other things that Anirban likes in the high growth. And I'm trying to think of one right now, but I just can imagine that I'm there thinking, no, actually Atlassian is a better quality business than Tesla. So, Doc can be in this high growth, most important business in the world, but I've got a sticky software, high gross margin one. So I'll be okay. But the reality might be that when Tesla tanks, then so does the rest of those ones.
So like there's a couple of different things. So you're touching on a lot of different things here. One is there's this thing called what people call the gamma trade. So what happens is you buy the call option. Call option gives you the right to buy the stock at a certain price. Now, if the stock goes up, stock has to go up. But if the stock goes up, those call options now are in the money, which means people can ask for those shares to be assigned, right? Well, then the counterparty has to provide those shares. So therefore they buy the shares. That causes the share to then go up, which means other call options get into the money, which cause more buying. So the market maker is basically constantly buying the shares, pushing the price up. And this can have a very fulfilling effect on the upside. The same thing can happen on the downside, which is why when people short the stock, when people famous people short Tesla, they go onto newspapers and TV and say, I'm short by several hundred million or maybe $1 billion. When actually they're not short by $1 billion. They're actually short much smaller because they're using put options to short and then have a smaller short. So they won't try to,
so they won't go bankrupt if it moves against them.
Yeah, so they won't go bankrupt, but the pricing action can occur on the downside as well. So here's my thing with this, right? Basically, if there is a market correction, it takes everything down with it. It's not a stock specific thing. And whether Tesla's valuation should be $1,200 or $800 or $600, that is a debatable thing, and that really depends on what the market thinks at any given point in time. One of the things that so this is one of the advantages, for example, of small caps, right? So that small cap space, and say if you take the ASX small cap space, pick any stock, Damtra, maybe 4 people follow it. Like there might be 4 broker reports or 5 broker reports on it, right? A big Telstra might have like 12 or 15 or some large number of people following it. So that, there is price discovery has happened for that, whereas price discovery may be still happening for Damstra. In the US, you reflect that because the companies are much larger. You'd see that by institutional holding, and actually holds true for Australian stocks as well. Like how much institutional holding is there for Damstra versus retail holding. Tesla has a much smaller institutional holding compared to, say, an Amazon or compared to a Facebook. So there's still price discovery. So there's a lot of different behavioral things that work. So it's a retail playground still. But one of the things that happens again in the market is just similar to say stocks getting added to ASX 200 or an ASX 300. If the stock is an ASX in the S&P 500 and you're a fund manager and you're underperforming because you don't own Tesla, well, now when the Tesla has gone up a lot, you kind of have to buy it. So there's buying pressure from all sorts of sides, and that's price discovery, right? I mean, you can call it a momentum, but it's actually also price discovery because all these people have to buy it because they didn't buy it in the first instance. So anyways, I mean, I think in the long run, it's the fundamentals that are going to decide the value or the eventual valuation of a company. So, and usually I look at TAM and then you can sort of, go from there. But anyways, that's how I think about it.
That's great. Guys, I'm going to ask you a question coming from the live chat, which is from the Equity Force Vinod, who asks, could you please share what you look for in a vertical SaaS company like Toast? And how would you factor in the opportunity cost of taking money away from horizontal SaaS companies? If any of you have any insights on that, feel free. Like basically, what are you looking for in a vertical SaaS company? Anyone want to answer that?
I was going to say, I don't know what a horizontal or a vertical SaaS is.
I've got to admit, I'm a bit confused by that. So
I'm stumped. But I can say what I look for in SaaS company. I look for stickiness.
Sure, do that.
Toast is, I believe, Toast, I believe, is another one of those POS companies. Whoa. Okay. Sorry. Maybe somebody else has to answer that question.
Okay. We've got a dog chiming in the background.
Yeah, we have somebody taking the dog away for walking. So and the dog is basically saying, well, are you a stranger or not? At least the dog does its work. So it has been validated. So, the thing is, I would say, I look for stickiness and I look at the problem they're solving. I think that's really important. If you're solving an important problem and you're sticky, that can be a really good place. And then this is what I call a floofy answer for which there are many ways to figure out whether or not it is relevant or not. And different companies are relevant in their own space. And then you sort of can then figure out the TAM. So POS is really hot these days, it's a point of sale. So that's like Tyro equivalent. And, there's so many people in that POS space. There's Toast. I believe Toast is in that space. And there's Lightspeed. There's like Square. Square. There's Tyro here in Australia. So, I mean, then Commonwealth Bank is in the POS space. So POS is really a hot thing these days. So anyways, that's my vague answer.
Yeah, that's fair enough. We'll talk about Tyro in just a second. I'll
have a crack at that one as well, though, if I can.
Sure. I'll just clarify one point that Vinod said that vertical is one industry only, and so Toast caters to the restaurant industry only, whereas Xero operates across industries, so it's horizontal.
Yeah.
Yeah.
So like it's actually going to lead into something else we were going to mention anyway, which is that a really classic example of what people would describe as a vertical SaaS stock is actually not really, it's sort of SaaS, but it is that kind of business model is actually Pro Medicus, right?
Of course, Pro Medicus, here it is again.
And the thing is, and this is really important, is that on the ASX, you basically want, like, basically most of the opportunities in software are vertical SaaS, as you'd call it, right? Because the big, and you've got examples of horizontal ones, which is like Xero is the best example that we probably all, well, I don't know about Anirban, but me and you like Owen. And I think that, you know, historically, like, I definitely feel like Anirban has talked to me about more horizontal style stuff. So, you know, one of the stocks, Doc, that you told me about years ago that I should have buy was like Twilio, which, again, not exactly SaaS, but classic example of like horizontal, like deep in the infrastructure stack there. So in terms of what do I look for in terms of vertical SaaS, is I think a really important thing to think about that people won't tell you about and isn't often talked about is for a vertical SaaS business, the amount or the profit margins that they are going to be able to charge has to do with how expensive the professionals are whose time they are saving, right? That's why, if you ask me, the economics of a vertical software as a service business that saves the time of radiologists is likely to be better than the vertical software that saves the time of accountants, and is likely to be better again than the vertical software that saves the time of people who are flipping burgers. So that's kind of something that I would think about. Now, of course, you have to think about that relative to price. If you're paying, 100 times EBIT for the one that has radiologists and a lot less for the one that's helping accountants, maybe the accountants one is a better buy. But that is something that is definitely worth considering, because for the buyer of that SaaS software, the limitation on how much they can pay and still it be a profitable decision for them is the savings that they are making on whoever's time they are saving by getting that software. And the more expensive that person is, the more they'll pay for the software, basically.
That's really interesting. We just had a question, and Vinos has great points, so thanks for that. From Liam, who said, "Is Pointera, that's ASX 3DP, an example of that?"
An example of a vertical or a horizontal?
Vertical. Sorry.
I actually don't know Pointera's customer base well enough to answer that question. To be quite frank,
I'd probably say it's a bit of both, because it principally serves asset owners. So it can be like energy grids, it can be any type of big asset owner, water infrastructure, stadiums, whatever, and they upload their data sets onto the platform, and then Pointera charges as the SaaS subscription. But primarily it was surveying that we're using it in the early days. So, and this is interesting because it's a slightly adjacent point to yours, which is that surveyors in themselves probably don't charge that much. They're not just going to charge as much as a radiologist, but as a project, it probably is a bigger deal. And so to save the money on a project is substantial.
Well, that's right.
Instead of remapping something.
That's the other thing that I didn't mention, and I'm glad you brought that up, is you don't just have to think about the hourly rate of the person whose time you're saving, but also think about how much of that person's time are you saving. So yeah, you might halve the time a radiologist takes to look at a study, but in the case of something like Pointera, or more likely, I think in this example, something like Ike GPS, a little liquid company on the ASX that does a similar kind of thing, that might actually completely reduce, that might more than half the time. That might, reduce by even more the need to send people out. That was sort of Nearmap's thing for a long time as well, as basically we can stop you needing to do site visits. Yeah. So you could imagine if the site visit goes down from once a month to once a year, then you're more than halving the expenditure there. So that's something to think about as well. Absolutely. I'm
actually going to save Amitesh's question for the end, because I think it's a really interesting one about just about which sector and companies are really exciting to you guys now. So maybe just have a think about that over the next few minutes. But Claude, you brought up Pro Medicus. Harry says it only took us 35 minutes to get to Pro Medicus. At $58, is it a buy, hold, or sell, mate?
Yeah, so I still hold some of it, but it's worth checking in. The history here is that in March 2015, I recommended it around $1.50 for Motley Fool Hidden Gems, and I've held it ever since then. So it's obviously I had a cost basis around $1, so it's like about a 50 bagger for me. I have sold at this point the majority of my shareholding already, and a lot of that selling has been above $50 in this year, right? So I have a scary tax bill that I'm about to get because I've just sent in my documents and everything. And and it makes me think, when I'm about to be hit with this tax bill, like, did I do the right thing selling? But, the pricing of this thing is like really insane for its growth rate. I don't think you have to look at it very long to say, well, yeah, there really is a great high quality business behind here. But yeah, like it's just the chances are that it can barely have any multiple re-rate go up. It's just, how can we get more optimistic about this stock? And I think that you have to consider that markets don't always represent value. And what you have in Pro Medicus is a company that is still 52% owned by its founders, right? Which speaks to its incredible economics. Now, incredible economics and a 55% EBIT margin is totally a reason to say, wow, this is a wonderful business. But what it also means is that they've been able to grow it without issuing shares. They haven't had to sell more and more shares and let every fundie get in. You know how it goes. You've been in a company the whole time. You've been the ups and downs, blah, blah, blah. It's finally getting big. It's about to like hit the big time. And then what do? I think EML Payments is a great example of this. What do? They slot out a ton of shares to every fundie who was asleep at the wheel and never got set. Then they can get set right at that late stage at a discount to whatever the market price is. When you do that, you're going to have a more functional and liquid market. But if you have a situation where you have a tightly held business and the founders have decided that they're going to use the business opportunities, the business quality, to grow the business without issuing shares and also without selling very many shares and without allowing that liquidity in the market. And then when you combine that with having a large number of retail shareholders who got in at very low prices, right? A very normal person who was looking at, like me, or anyone really who's looking at Pro Medicus a few years ago, can go and buy $20,000 worth of shares that suddenly becomes $200,000 a few years later. And a lot of these people, they're going to sell some out, but a lot of these people are going to be like me in that they're going to do so slowly and only at a high price. Well, you've got all of these index hugging funds, which I'm sure is a concept that, most of us understand, but that maybe we can explain that later. But funds have sometimes an incentive to just make sure they own a bit of everything. And so they are underweight, a star stock. It's dangerous for them. And they just want to make sure they have some of it in case it does outperforming. It doesn't cause them to lag. So you have index funds that also just need to automatically buy. So you have a lot of valuation insensitive demand for the stock. And that can mean a period of like a fairly elevated share price, basically. And that may not be a reflection of the fundamentals. And I think, we're seeing that now. I think somebody asked, what's the stock you're excited about? Well, I own Pro Medicus and have been selling that now. But one that I haven't really been selling, I think I bought some and then I sold a little bit. But basically, I've just kept my core position, is a company called Objective Corp. And that has similarities, right? It's still very expensive, but not as expensive as Pro Medicus, but it has similarities with Pro Medicus like a few years ago, not in saying it's such a good company. I'm not saying, it's definitely going to go up and double or anything, but it has that same quality where you have a high quality business that hasn't needed to dilute. The founder has held on to his shares. The founder hasn't, even if he sells a little bit, that's probably not going to make a difference. This thing keeps getting bigger and bigger. It's above $1 billion. It's still not in the ASX 200. So it's just a matter, it's possible, it's not just a matter of time. If it keeps delivering, it just gets a little bit more liquid and goes a little bit like the share price goes up, that shakes out people like me looking at, oh, this is expensive, or there's a fundy that's got some and they start feeding it out. It becomes more liquid. Lo and behold, finally gets liquid enough to get in the ASX 200. Then what happens? You have a bunch of people that just need to buy the stock at any price. That's when you can get these blow-offs in the share price that have little to do with the actual value of the company and more to do with the market dynamics that can be created by the best kind of founders, who are the ones that don't raise capital and hold all their shares. And then that's when you get you want some excitement. I'm excited about that. I don't know if it's going to happen. I don't know when it's going to happen, but I'm holding my objective shares because I want to see something really stupid happen in that share price. And I want to be holding when it does.
Well, it's hard. It is hard to talk about Pro Medicus and then talk about another company, because some people do think that you're saying this is the next Pro Medicus.
I'm not saying that.
This is a similar characteristics, but just full transparency there.
Yeah, I'm not trying to say that at all. And it's a totally different business. One does software for radiologists, the other does software for bureaucrats, basically, but and local councils. And so it's obviously a different market. One's all in the US. One's mostly in Australia. Totally different companies, different prospects. But you have that same quality where the founders themselves have been, in the case of both of those companies, they haven't been issuing new shares to raise capital over the time that they've been listed, that I've been watching them. They've been actually buying back shares. And that is, that can get silly. And if you are going to, if you want to look at this at a high level, like, profitable software companies that have good business models, high margins, sticky customers, and then managers who are buying back shares rather than issuing them, that's an interesting place to play.
For sure. That's Objective Corp on the ASX. Pro Medicus is at 65 times sales for those of you that are interested. Which is quite the multiple. So I own that. I've owned the shares. We've had them on a hold for a long time since we recommended them.
But call out to you. I beamed with pride and joy when you made Pro Medicus your first Rask Invest recommendation.
Yeah, thanks. I remember you calling me up and saying, well done on that one.
You picked the best one.
Maybe, half like, half skill, we'll say. Another update, which I'll cover quickly, was just out of Tyro. It got brought up before. Tyro Payments is the point of sale business here in Australia. It also has got this little lending business that it's starting to do. It's kind of like in maybe a less glamorous version of Square out of the US. It's not as consumer friendly, but it focuses on merchants. What was really interesting this week is they came out with their AGM, and there was an outlook statement there that was provided. There was nothing, I would say, that was really concerning, but I just sat through the AGM, and to be honest, it was one of those really kind of boring ones where no one asks questions, and I forgot my shareholder reference number, and so I couldn't ask a question. So I was just sitting there passively, and there was no questions throughout this whole thing. And then at the end, it's about halfway through the AGM, the shares started down 3%, and they got down to around about 15% or 20% down before the AGM concluded. And the management team actually left the audio device on after they closed the meeting. And someone in the background said, have you seen the share price? And then I don't know who it was, someone else said, did I say something wrong? So they had no idea, I don't think, what was going on in the market at the time of their AGM. But the shares got sold down kind of viciously. I didn't really know what happened either. And so later that afternoon, I believe it was, or maybe it was the following morning, they've come out and they've clarified some numbers. And one of the things that they said is our transaction value, so the value that's going through the point of sale terminals, was up 25% to 8.97 billion. But the gross profit, which I've got here, was 38.5 million, up 14%. So there was a kind of dislocation between the revenue, or the transaction value and the gross profit. And I think maybe what people have missed here, I don't know, I'm just speculating because I don't know the real reason why it got sold off. There were 4 or 5 really big trades that went through, just straight up trades, which is a bit interesting. People don't realize that Tyro's been on a bit of an acquisition spree in terms of buying other kind of adjacent providers. And one of those was Bendigo Bank. And the revenue model that they disclosed from that wasn't really clear when they did it. We knew in our notes that it was going to be lower margin revenue. We just didn't know how low it was going to be. And I think maybe that's what spooked the market, because they said if we excluded that, then gross profit would have been up 22%. So it was a bit more in line with, I guess, where they were going in terms of transaction value. But a really interesting one. I don't know if you guys know much about Tyro, but there's two listed on the ASX. There's Tyro, which is the big brother of SmartPay, which is a smaller Kiwi turned Australian business. So both interesting companies, both in that space, fighting with Square and Albert from the Commonwealth Bank of Australia, which is the big incumbent. Point of sale makes money by clipping the ticket as things come through. SmartPay is a little bit different because it pushes the zero charge or the no kind of charge on. It doesn't charge the merchant. It tries to charge the customer. So you just pay a little bit extra when you get your cup of coffee. Both really interesting businesses, but Tyro's down this week. Full disclosure, we still have it as a buy. I can't really, other than the slip on margins, I can't really disclose, I can't really say what it is that sent the share price down. If anyone out there is watching and they think, I know the answer to that, please let us know. You can find us on Twitter. But that's Tyro Payments. I thought I'd have to be quick through that one because I wanted to jump back to you, Anirban, and you've got two companies you want to talk us through. You can share your screen if it helps. Otherwise, we're going to talk about Peloton and Cloudflare. So two really interesting companies. Many people know Peloton because if they're into fitness. Tell us a little bit about these guys.
Yeah, so we'll see. We'll try to run through these quickly. So for Peloton, revenue in the first quarter only grew 6%, and wow. So that's a big pullback in growth, I guess. The other thing is what they call it connected fitness quarterly workouts. I guess the total number of workouts that are happening in this connected fitness experience that they're providing, there was about 120,500 odd, which is while it was up relative to Q1 of last year. This was Q1 2022. It's sequentially down now from Q3 and Q4. So basically, like the pandemic being kind of over in parts of the world, or many parts of the world, or people at least assuming the pandemic over. The pandemic might not be over. The pandemic has become endemic, but usage of Peloton has decreased because people are probably going back to the gym. So I think this is fascinating because what happened when I clicked the link to actually open up our Zoom link. Zoom gave me an advertisement saying, "Hey, do you want to join our fitness classes?" Really? So Zoom is doing meditation live fitness classes and things like that. Right? There's Apple Fitness. This is a very competitive arena, and it's going to be really tough for a company like this to this is like a $20 billion or something, or was $20 billion until this and after hours, I think it was down like 27%. So take a quarter of the valuation away, whatever is the valuation now. This is going to be tough because down
30% after hours.
Okay, so down 30%.
Anirban, I have a burning question for you that kind of taps into this.
Yes, tell me.
What's your take on, I guess, to me, I look at something like Peloton, this idea that we're all in our homes on a stationary bike with a video linking us to whatever. And I look at, say, the Facebook idea of the metaverse or whatever. And to me, it feels like that direction for technology, I'm not saying it won't succeed, but it seems massively dystopia to me. It doesn't seem like, do we think, first, there are two questions. Do we think that there's like some intrinsic value in people actually going outside and breathing the fresh air and hearing the birds while they exercise? and also, just generally while they live their life? Or do we think that, right now we're doing Zoom and we love it, but do we think that in a few years, actually now we're just hopping into the metaverse to get together? Or is it actually going to be a point where people say, hey, like we've had a year of massive Zoom and we're never going to let it go, and we can work together like this when we live in 3 different cities, and that's great, but that's enough. We still do want to get together when we can to have a beer and have a meal or whatever, and the Zoom thing's enough. We don't need to go further into that virtualization of everything.
Yeah, so I tend to agree with you. I think, so I've personally seen this, like my daughter plays a lot of Roblox, and it's a game I have come to despise a lot because it's just a time waste. A lot of the app economy, I call it a time waste because it's just brain numbing, time wasting, eyeball driven. It's not really adding any positive value other than for bringing eyeballs, which the advertisers are bombarding, a lot of fake news. So yeah,
she doesn't listen to the Australian Investors podcast, does she?
No, she doesn't. There's beautiful content here. Of course, she doesn't listen to this. She's playing some game, building some virtual world in. So I'm not a fan of the metaverse. See, here's the thing, right? So I don't want to get into that metaverse conversation in the sense that I think there's a lot of hype. Whenever a company goes through this hype phase, they are basically either deflecting or doing something else. Or to put it simply, right? If I am trying to create the new compute platform, and I want to have a leadership position in it, I'm not going to advertise it so that Google and Apple and Amazon are going to copy it, right? It is more for press, it's more for deflection, it's more maybe for hiring, and this whole thing is like, several years away, in which case, stuff will change. So I'm not a big fan of this. Going to connected fitness, right? There is a use case for connected fitness. So, I have some gym equipment, I use it with my phone, but I use it with Apple Fitness. Somebody could use it with Apple Fitness, somebody could use it with Zoom, right? Maybe there's a room for that, and some people are going to go to the gym. The whole idea that the whole world is needing this virtual exercise classes, which is what sort of fitness, a community around virtual reality of people exercising, that seems a little far-fetched to me, exactly to your point. If you need that, you probably go to the gym.
It blows my mind, right? I get why Peloton did well in a pandemic, but it blows my mind because I think back to, everybody I know, and one of the reason people goes to the gym is because they see other people there, and people meet their life partners at the gym. Think about this. If you're single and you're going to the gym because you want to keep your body in shape and look real sexy, then going to the gym also becomes an opportunity for you to meet other people that are taking care of their body that you might be interested in. Not only that, but a situation, and by the way, I hate gyms, so this is not an advertisement for gym, but I'm not stupid. And I know that if I were, when I was dating, what you want to do is you want to do things where you feel good together. Well, guess what? Exercise releases endorphins. And so it's a great way to break the ice. And if you want to, let me tell this to any other little investing nerds out there that want to improve their game. One of the best things you can do is go for a walk, get the endorphins pumping, and you see something beautiful. You're setting yourself up to succeed. So the idea that all these young people that are trying to make their connections in life and meet people and all of that would prefer to do the stay at home thing, it doesn't feel. Look, maybe it's going to work out and that's what will happen, but then we're just going to put even more reliance on Tinder and all of that kind of stuff. So for me, I think that, obviously I think there's a point at which people want at least enough in-person kind of interactions. And it seems like a lot of the innovation that we've seen recently is about reducing those interactions.
I'll just say one thing. Okay, maybe you're making the assumption that this is for young people. What if this is not for the young people? It's for the old people. And
also, there are old people that are out dating as well. Of course. So
what about the universe of people who are couch potatoes and don't want to go anywhere? Maybe it's for them. Maybe that universe is small. But yeah, I'm not a fan really of this business. But I think this is. My point really was that if you think about the gross margins, you think of the market cap, and you think about the growth, I don't know how. It was bound to get the shellacking it got. Okay, what else was I supposed to talk about?
Cloudflare.
Yes,
Cloudflare. We've got strong results from Cloudflare by looks of it. Looking at the headline numbers.
Yeah, really strong results from Cloudflare. Yes, a couple of things.
There's that Starlink.
So this is
brutal. The brutal truth comes out.
So this was the first quarter, I think, after them going public, where they had an operating profit. So they tipped into profitability, although they've said that they're going to go back, or they're going to be sort of hovering around there. So they're going to basically invest every dollar that they earn. The other big news was that their customer ads of large customers, defined as those people with ACV or annual contract values of 100,000 or more, that is increasing at a phenomenal pace. So while the revenue grew at 50%, I think that was at like somewhere close to 70%. So growth of on the large customer side. So that is really, really good. The product, they're really bringing product innovation, pace of innovation is really, really strong there. So just new products are coming, and they're really good at sort of iterating through things. So I mean, this company still probably has pro Medicus like multiples of sale, but the multiple has expanded really a lot. So there's a lot of, I guess, expectation baked into it. One of the things that is very interesting here is sort of their edge computing platform, where they're actually enabling storage of content. So, and the game that they're playing there is, so that is ingesting data into a cloud environment. Typically, so if your AWS does not cost you money, but egressing data actually costs you money. And what they're saying is that egress should not be costly. So they, basically that's a lock-in, right? If you can't take data out, if it costs you money to take your data out, then that's a lock-in. Over time, you have more and more data sitting with your central cloud provider. So they are building this flexible platform, which is edge-based, which is looking to sort of, I think, capture some of the cloud TAM. And this last week, Owen, you remember we talked about this. So if you just look at the big three in cloud, they're sort of at 110 billion per year run rate, growing easily at 35% plus. So that's a phenomenal, like just tells you how big that infrastructure in the cloud opportunity is. And these guys sort of want to have a slice of that. So, I mean, even if they become, a fourth, horseman behind Google, Google is on a 5 billion per quarter run rate. That'll be a significant achievement for this company, which is, still a sub 1 billion revenue run rate company. So again, I really like this company. I really like this company because I really like how the founders behave and how the founders pursue things. And one of the biggest things in competitive software land is just your pace of innovation. And your pace of innovation really is the most important thing. And if you have a platform that allows you to innovate quickly, that's really important. So these guys are really fabulous. So it's a company definitely that should be in people's watch list.
I can't believe I didn't hold that long enough. I can't believe I bought that just as a part of a grab bag of high growth stocks in June last year, and then I sold it. It's just terrible. It's been probably the best performer, one of the best performers of the lot. I spent
the first part of the pandemic looking at Fastly. So
and not only did I buy Fastly, but I sold Cloudflare. It's so painful. So I did buy some good ones as well, by the way. CrowdStrike, Atlassian, Upstart. Have you looked at DigitalOcean, Anirban?
I have looked at it briefly, but
I own that one.
You own that one. Okay, then I should look at it. I haven't looked at it very closely.
ServiceNow is one of my favorites as well. That's actually probably one of my bigger positions. Anyway.
Yeah, ServiceNow is great. One of the funny things, because you said Fastly, is I read the Fastly call first, and then I was immediately after I was reading the Cloudflare call. And, if you read the two side by side, it really depresses you about Fastly because, the Fastly call does not inspire. And nothing wrong. They're just boring in the way they just sort of present stuff and talk about things. Whereas these guys are very inspiring and thoughtful and sort of, they demonstrate leadership. So anyway, just to the side.
Yeah, it's usually, you usually go better if you manage to invest in the sort of the leader rather than one that has all sorts of problems. I should have seen that one coming. Oh well.
We can't win them all. Maybe we've gone a bit over time today, but there were a couple of other companies that we're going to talk about, which is Pinterest. Just quickly, Pinterest reported its third quarter this morning, guided for pretty weak results in the second quarter, so analysts weren't expecting much. Pretty strong top line growth, revenue up, considering they're investing in their idea pins and heavily investing into video, which they say is more focused around inspiration than entertainment, which is what you might get from TikTok and YouTube and all the rest of them. But it's still, I was on it this morning. I was on the app. Speaking of fitness, because as I was listening through the quarterly report, I was in the gym. I do go to the gym every now and again, Claude, and and I actually went on there and I noticed that they've added a heap of things like, if you're in the gym, you can see workout videos and get inspiration that way. So it's not necessarily, it's kind of transitioned away from just the home and renovations and food to more lifestyle things as well, which are really popular on the platform. But just in short, revenue strong, users not as strong as people would like, but probably better than expected, and guiding for a growth quarter in the fourth quarter, which is pretty strong considering they're coming off COVID last year. They're basically the opposite play of COVID or lockdowns. If we go into lockdowns, Pinterest does well. Come out of lockdowns, Pinterest doesn't do as well. So it's facing those headwinds at the moment, but it's handling them pretty well. A lot of work to do on the monetization effort, but they've got shopping features, more advertising. So they've come a long way in that regard. But that's Pinterest, NYSE pins is the 2 code. Claude, I know that there was one more thing that you had on your list, which was just IntelliHR. Can you give us the 90-second, what happened to IntelliHR today?
So I think it's sort of it's sad to see what's happening to the share price as a shareholder. So what's happened is today they've put out an excited announcement. Not entirely sure why, but it has to do with them saying, the $5 million ARR key growth milestone achieved, right? So this has all the hallmarks of a pointless announcement. Like, give us the quarterly, updates for sure of your ARR. But why the hell does it matter that you passed 5 million? Like, I get it's a round number, but why not just put out an announcement randomly that's like, the milestone of 6,000,175 has been passed. It's just you want to talk about how you're growing your ARR, right? Like, that's the thing. And, it's just been really, as a shareholder, I've definitely got to pull my punches here. But what happened is that this is a high growth SaaS stock, right? And what happens is you get some people like myself that buy shares because we think that, we like to buy these high growth stories because people can underestimate when growth goes exponential. Things can get really good. They don't always, but if you keep making that bet over and over again, you can do pretty well. So I owned shares and fully expected there to be another capital raising. But previously, when they'd raised capital, they'd given existing shareholders a chance to participate in that. But instead, what they did was really ugly, which was to do a discounted capital raise to, sophisticated institutions or whatever, and no opportunity for shareholders, like common shareholders, to buy shares. And the CEO sold a bunch of shares into that capital raising as well. And this was done at a fairly big discount to the prevailing price, which is then how the brokerage that's doing it can convince a whole bunch of people randomly to buy shares all of a sudden when the CEO is selling by being like, oh yeah, but the share price is at 27 cents or 28 cents. I can't remember what it was. And you can buy shares at 23 cents. So, it's free money kind of thing. Well, yeah, maybe that's how it gets sold to the company to do it that way. But the reality is that is a double shafting for retail shareholders, because not only do you not get the opportunity to buy those discounted shares, but what has happened is then the shares have gone to other people who probably didn't really want it, mostly just wanted it because it was a discount. And then the idea is that what the brokers want to happen is for those people who get the shares to sell it on market for a profit to someone who did want it. So it's exploitative in my view. It gives a raw deal clearly to the existing shareholders who don't get an opportunity, who get cut out and have to try their luck on market. Well, guess what? Retail shareholders, there is a fight back here because we're not silly. We can see what happens. And what you're sort of seeing increasingly when companies pull this maneuver is retail shareholders. So, I don't like how we're getting treated. This reduces my opinion of this company. And so they turn around to sell on market. And guess what? It is very obvious that you've just given shares to a bunch of people who don't know the company as well as the shareholders. They're not shareholders, right? So some of them anyway. So they obviously like the stock less. So you get this herding response where retail shareholders will, and anyone who owns shares will then sell, which then eliminates the profit that was promised to the people that got the shares anyway. So now these, I shouldn't say poor, but these people who've bought the shares at 23 cents, have all these shares they didn't only bought because it was a cheap shares, and they're looking to sell that on market. And then the really sad thing is when you see these kind of announcements like, hey, 5 million ARR, this is great, positive announcement, right? Well, share price down, because you can't, as I said, you have to analyze the company, but it's helpful to analyze what's happening in the stock. And the reality is it's hard for that stock to go anywhere while you've got this overhang of people who just got it for the discount. And then meantime, there are people like me. I sold a bunch of my IntelliHR shares on this news, and I've bought some of them back under 23 cents. My goal is to buy back my position in IntelliHR, but maybe a smaller position now because I like the company less, and I want to do it at less than their capital raising price. So you would buy back shares if it fell below a certain level. So you still like the fundamentals of the business. I do. It is growing well. Okay. It's just really sad. It's really sad as a shareholder to see you just know when you see this behavior, you just know, look, you might be buying a good price and it could go up from here. I think it probably, it still keeps growing, right? If it keeps growing its ARR, then eventually the share price will follow. So I don't think it's a bad investment. And what I did was I sold into this situation, and then I've actually bought back some already under 23 cents, or maybe at or below 23 cents. But it just means that, as I said, when I'm going to get really excited about position, it's not going to be a company that's doing this kind of maneuver. It's either one that does the buyback shares and doesn't need to issue shares, or it's one that when they do issue shares, they try to do that in the most even way possible, keep all the shareholders on board. And what's more, if you're going to be giving new shares to existing shareholders, that's more likely to be sticky hands. And, give the shares to people that already like the company. There's much more chance they're going to hold on to them and not flip them for a quick profit. And we see that. And generally speaking, one of the software companies that I bought this week and I'm going to be publishing about tomorrow, they did it. They did the right thing in a capital raising recently. And what you've seen is that the share price has been sitting just above that capital raising price. So it seems like they've priced it reasonably well and they've managed it really well. And actually, that is what initially made me think, look, I got to give this one another look, because this management behavior is consistent with behavior that I admire. So let me have a look at this and see maybe this is actually something that could be a good holding.
Yeah, that's a hell of a 90 seconds. And
sorry, mate.
It's IntelliHR, IHR. No, I love it, man. I love it. We wrote about IntelliHR inside the RAS Rockets program. It wasn't an official pick because I was just a bit concerned. So many acquisitions and the cap raisings along the way. I couldn't. Yeah, I was worried. I didn't see this coming, but I was worried about this type of thing.
I think you probably made the right call. I think I got in there at the wrong time. And the share price just had too much hype in it. And as it turns out now, I haven't done too much harm to myself because I did make the decision to sort of sell when I did. But yeah, look, it's definitely it's a high growth software company that's small, so that's always going to make it interesting in my book. But at the same time, there's a few shorter term things weighing on the share price, and I don't know when that's going to clear.
Mm-hmm. Cool. Okay, so thank you to our special guest today, Claude Walker from A Rich Life. You can head to arichlife.com.au to find out more about what Claude and the team are doing there, arts, culture, and of course, investing. Mate, there's like a subscription, a supporters only section of the website, if I'm not mistaken. Is that correct?
Yep. So, if you want to check out our full stuff with extra articles and articles sort of sooner and that kind of thing, then we do have a wait list and people can hop on and once a month around then we invite everyone on the wait list to see if they want to join. And the reason we have that wait list is because we offer a pro rata refund at any time for any reason. So that's why you kind of you can't just be constantly open, because otherwise then people could buy it and then get a refund and buy it and whenever they wanted to. And it would just be a lot of admin for me. So that's why we have that.
Yeah, cool. I like it. And Anirban, always a pleasure, mate. Every week, always a bit of fun. Hopefully next week, we'll be back with some more US stocks. But in the meantime, if people want to get your November recommendation, they want to tune in for this webinar, they want to do all those lovely things, where do they go to find out more?
Just go to 7investing.com/subscribe or just go to 7investing.com. Don't even have to hit subscribe. There's a lot of free articles there that you can read. All our podcasts are there, a lot of free articles there. So yeah.
Yep. And don't forget, if you do subscribe, to use the RASK code, that's RASK. The webinar is coming up next weekend. Is that correct? If you want to learn about cybersecurity, zero trust, that'll be awesome. So that'll be in the show notes. We put it in the YouTube chat there, the live chat, if you want to dial in for that. It's free. Just pop in your email address and you're good to go. If you want to find out more about me and what I'm doing, head to rask.com.au. You can take one of our courses or jump on one of the subscriptions if you want to support us. It's always good to hear from everyone. So please jump on Twitter, share your thoughts. Every week we want to go live and we want to do a podcast. So, say good day, give us some suggestions. We've had some wonderful ones today. At 7A Mahanti, and we've got at Claude D. Walker. I'm at Owen Rask on Twitter. Until next week, we'll see you then. Gents, thanks for joining me.
Thanks, mate.